You have been told that taxes are the price of civilization, that they fund roads, armies, schools, and hospitals, that they are the mechanism through which a society pools its resources to serve everyone who lives inside it, and that while nobody enjoys paying them, they are fundamentally neutral, a necessary cost distributed across the population according to some reasonable principle of shared burden. That is the story. And like most financial stories told to ordinary people, it contains just enough truth to be convincing and just enough omission to be dangerous. Because here is what the historical record actually shows. Tax systems are not neutral. They have never been neutral. From the moment organized states began extracting revenue from their populations, the design of those systems, who pays how much, through what mechanism, with what exemptions, enforced by whom, has been shaped by the people with the power to design them. And the people with the power to design tax systems have never been the people who bear the heaviest burden under them. Rome proved this at civilizational scale over 8 centuries. And what Rome built, the structure, the logic, the mechanisms of protection and exposure, is not ancient history collecting dust in an academic archive. It is the template that every subsequent tax system in the Western world has borrowed from, refined, and in many cases made more sophisticated without making more equitable. By the time this video ends, you will understand not just how Roman taxation worked, but why it worked the way it did, who designed the protections built into it, and why the system you pay taxes inside today contains the same fundamental architecture that Roman senators designed 2,000 years ago to protect their own wealth while extracting maximum revenue from everyone below them. Let us begin with what Rome actually needed money for. Because the justification for taxation always begins with genuine necessity, and Rome's necessities were real and enormous. At its peak, the Roman Empire was the largest administrative and military enterprise the ancient world had ever produced. It maintained permanent legions across thousands of miles of frontier from Britain to Mesopotamia. It built and maintained road networks, aqueducts, grain supply systems, and administrative bureaucracies across dozens of provinces. It paid soldiers, officials, engineers, and administrators on a scale that required continuous, reliable revenue streams measured in millions of gold and silver coins every year. This was genuine state necessity, not invented, not exaggerated. Rome needed money the way an empire needs oxygen. And the question of how to raise that money, from whom, through what mechanism, with what consequences, was the central political and economic question of the Roman state for 800 years. The answer Rome settled on reveals something that most histories of taxation carefully avoid saying directly. The answer was always the same. Make the extraction as efficient as possible from the people least able to resist it, protect the people most able to resist it through legal exemptions and political access, and call the resulting system a neutral public obligation. Let us start with the Republic. In the early Republican period, Roman citizens paid something called the Tributum, an extraordinary levy assessed by the Senate that varied year to year depending on military. On paper, this sounds reasonably broad-based. In practice, the Senate that decided the Tributum rate was composed entirely of wealthy landowners who had every incentive to keep the rate low on the class of people they represented and shift the revenue burden toward other sources. Those other sources were the provinces. Because in the provinces, the territories Rome controlled outside Italy, taxation worked through an entirely different system. Rome outsourced tax collection to private contractors. The Publicani, wealthy Roman businessmen who bid for the right to collect provincial taxes, paid the state up front, and then went into the provinces to extract as much revenue as possible to recover their investment and profit above it. We covered the Publicani in detail in our earlier video on Rome's banking trick, but here the relevant point is different. In the context of tax design, the Publicani system reveals something fundamental. The Roman state, when designing how to collect revenue from its most vulnerable populations, provincial farmers, traders, and smallholders who had no political representation in Rome, chose a mechanism that was structurally guaranteed to produce abuse. Private profit-seeking collectors with legal authority and no accountability to the people they taxed. The abuse was not a failure of the system. The abuse was the system working as designed. But nothing in Roman tax history illustrates the structural inequality of the system more clearly than what happened in Roman Egypt. Because Egypt was not just a Roman province, it was a tax laboratory, the most extensively documented fiscal system in the ancient world. And what the documentary record from Roman Egypt shows is one of the most elaborate extraction mechanisms ever imposed on an ordinary population. In Roman Egypt, taxes applied to almost every aspect of human existence. There was a tax on your person, the poll tax, a tax on your land, a tax on your occupation, a tax on sales transactions, a tax on property transfers, a tax on transport and movement of goods, customs duties on imports and exports. In total, historians have identified more than 100 separate taxes, fees, surcharges, and levies operating across the Roman and Byzantine periods in Egypt alone. 100 separate charges on farmers, on traders, on craftspeople, on people moving goods between towns, on people inheriting property, on people conducting ordinary commerce. The state had found a way to insert a revenue extraction point into nearly every economic activity a person could engage in, and here is the part that makes this story directly relevant to the modern world. Not all of these charges applied equally. Roman citizens living in Egypt and certain Greek urban communities were exempt from the poll tax. The tax that fell most heavily on adult male rural inhabitants, the people who produced the grain that fed the empire, did not apply to the class of people who were closest to political power in Rome. Roman citizenship in the context of Egyptian taxation was not just a legal status, it was a tax exemption. The more citizenship you had, the more exemptions you qualified for. The less citizenship you had, the further you were from Rome, the more provincial your origin, the more rural your life, the more of the system's burden fell on you. Status was the original tax shelter, but the Egyptian poll tax and its citizenship exemption is only one dimension of the inequality built into Roman taxation. There was a second mechanism, less visible and more insidious, called the liturgy system. And it is one of the most overlooked features of Roman fiscal history. Liturgies were unpaid public service obligations, local administrative duties, maintaining records, supervising tax collection, managing public property, organizing grain distribution, that the state needed performed but did not want to pay for. So it simply mandated that certain people perform these functions as a civic duty without compensation. In theory, this sounds like it could fall on anyone. In practice, it fell almost exclusively on local elites and appointed administrators, the middling property-owning class of the provinces, not the Roman senatorial wealthy who were too powerful to be compelled into provincial administration, not the desperately poor who had nothing to offer. But the small landowner, the local businessman, the moderately successful trader, precisely the people who were doing well enough to be useful to the state but not powerful enough to refuse. The liturgy system meant that the provincial middle class was not just taxed monetarily. They were taxed in time, in labor, and in risk, because the state held liturgy administrators personally liable for the tax revenue they were supposed to collect. If the community could not pay, the administrator could be compelled to make up the shortfall from his own pocket. The state had created a system in which the people administering the extraction bore the financial risk of its failure. Think about what that means in structural terms. The state outsourced the risk of tax collection failure to the least powerful people involved in the process. Publicani who failed to collect could pressure farmers. Local liturgy administrators who fell short could lose their own property. The Roman treasury sat at the top of this chain, collecting revenue that flowed upward through a series of human pressure points, none of which touched the senatorial class who designed the system. And then Diocletian reformed it. In the late 3rd century AD, the Emperor Diocletian introduced what historians call the capitatio iugatio system, a comprehensive restructuring of Roman taxation that was presented as making the system more rational, more predictable, and more efficient. The reform worked by tying tax assessment to two things simultaneously: land and labor. The iugum was a unit of taxable land. The caput was a unit of taxable labor. Tax obligations were now calculated based on how much land you worked and how many people worked it. The system was designed to be stable, measurable, and comprehensive. And in narrow administrative terms, it was more efficient than what came before. But efficiency concealed a profound social consequence. Because when tax assessment is tied simultaneously to land and to the labor working that land, the state creates a powerful fiscal interest in keeping that labor exactly where it is. A farmer who abandons his land is not just losing his livelihood. He is creating a gap in the state's tax assessment. He is depriving the treasury of a caput, a taxable labor unit, and the state cannot allow that. This is the moment in Roman fiscal history that most directly connects to the origins of serfdom. The capitatio iugatio system did not explicitly forbid peasants from moving, but it created structural conditions in which a peasant who moved created fiscal problems for the landlord, the local administrator, and ultimately the state. Landlords had every incentive to prevent their labor from leaving. Local administrators had every incentive to keep their taxpayer population stable. And the state had every incentive to support both of those interests over the interests of the individual farmer who simply wanted to find better conditions elsewhere. Mobility became a fiscal problem. The poor person's most fundamental economic tool, the ability to move to a place with better opportunities or lower exactions, was made structurally threatening to everyone with power over him. And in a system where everyone with power over him had financial incentives to keep him in place, he stayed. Not because of explicit slavery, because of fiscal gravity. Now let us talk about the debt trap. Because the capitatio iugatio system and the broader Roman tax structure created one of the most consequential debt mechanisms in ancient history. Tax obligations in Rome did not adjust automatically to human hardship. Harvest failure, drought, flood, disease, military destruction, none of these automatically reduced what the state demanded from the people affected. The obligation remained. The state's need for revenue did not pause for human misfortune. And when a farmer could not pay his tax obligation after a crop failure, the state's response was not relief. It was enforcement. Collectors could threaten both taxpayers and the administrators responsible for them. People who could not meet obligations sometimes abandoned their property entirely, walking away from everything they owned, simply to escape the relentless pressure of an obligation they could no longer meet. The documentary record from Roman Egypt contains accounts of people fleeing their villages to escape tax collectors. Not criminals, not tax evaders in the modern sense. Ordinary farmers who had suffered an agricultural disaster could not pay what was demanded and faced consequences severe enough that abandoning their land and their community was preferable to staying. The tax system had made the choice between staying and suffering or leaving and losing everything into the only choice available. And when people fled, the remaining community members were often held collectively responsible for the missing payments. Because Roman tax administration frequently operated on the principle of collective liability, if one member of a taxable community could not pay, the obligation did not disappear. It was redistributed across those who remained, which meant that community cohesion itself became a fiscal trap. You could not leave without burdening your neighbors, and your neighbors could not let you leave without bearing additional burden themselves. Meanwhile, at the top of the Roman social structure, the mechanics were entirely different. Wealthy Roman senators and equestrians were not standing in Egyptian villages being threatened by tax collectors. They were in Rome, in the Senate, participating in the decisions about how the tax system was structured. They held land in concentrated estates large enough that the per-unit tax burden was spread across enormous productive capacity. They held citizenship status that exempted them from many provincial levies. They had political connections that allowed them to negotiate terms, delay obligations, and access the exemptions written into the system by people very much like themselves. And as the late Roman period progressed, a new protection mechanism emerged that formalized the relationship between wealth and tax insulation. Small landowners, under fiscal pressure they could not sustain independently, began placing themselves under the protection of large landowners and powerful patrons who could negotiate with the state on their behalf, absorb tax obligations into their larger fiscal arrangement, and provide physical protection from collectors. This practice, called patronage dependence, sounds like a social arrangement. It was also a fiscal one. The small farmer who placed himself under a patron's protection gained some relief from direct tax pressure, but he paid for it with his independence. He became, in practice if not in law, bound to the patron's estate. His labor, his production, and his economic future now operated within the patron's orbit rather than his own. The rich man's protection came at the price of the poor man's autonomy. The state eventually recognized and formalized this arrangement by making large landowners responsible for the tax payments of their dependents, which completed the circle. The wealthy patron now had formal legal authority over the tax-dependent population attached to his estate. He collected from them. He paid the state. He kept the difference. And the state had effectively privatized the tax relationship between itself and the poorest segment of the rural population, routing it through the wealthiest segment as the intermediary. If you're listening to this and finding it uncomfortably familiar, you should be. Because the structural pattern, tax obligations that do not adjust to hardship, mobility restrictions created by fiscal pressure, collective liability spreading individual failure across communities, elite exemptions embedded in the legal structure, and the privatization of tax relationships through powerful intermediaries, is not a Roman artifact. It is a recurring feature of every complex tax system ever built in the Western tradition. The carried interest exemption that allows private equity managers to pay capital gains rates on income that any economist would classify as ordinary wages is a modern legal distinction embedded in the tax code by people with the political access to put it there. Exactly as Roman citizenship status was embedded in the tax structure by people with the political access to put it there. The offshore wealth structures used by the world's wealthiest individuals to legally minimize tax obligations in the countries where they actually live and profit is a modern version of the patron-dependent relationship, routing taxable wealth through legal structures that insulate it from the obligations that apply to ordinary wage earners who cannot access those structures. The property tax systems in most U.S. states that assess commercial real estate at fractions of its actual market value, while fully assessing residential property owned by ordinary homeowners, is a modern version of the senatorial land tax arrangements that protected Roman elite estate wealth while exposing provincial smallholder land to full assessment. And the use of collective liability, In modern terms, the structure of payroll taxes, consumption taxes, and value-added taxes that extract a larger proportional share from lower incomes, because they apply to spending rather than wealth accumulation, is the modern equivalent of the Roman poll tax system that fell on rural inhabitants while urban elites with the right status classification paid less. The Roman tax system was not designed in a single meeting by a group of villains who sat down and said, "Let us make the poor pay more." It evolved over 8 centuries through thousands of individual decisions made by people with power over the system's structure. And those people with consistent regularity across 8 centuries made decisions that protected their own class from maximum exposure while ensuring that the people below them, who had no voice in the design process, absorbed the heaviest burden. That is not a conspiracy. It is the predictable outcome of allowing the people who benefit most from a system to be the people who design it. It happened in Rome. It happened in medieval Europe. It happened in the construction of the modern tax code. And it is happening in every legislative session happening right now in Washington, Brussels, and London, where the most heavily lobbied provisions of tax law are the ones that protect the largest concentrations of existing wealth. Diocletian thought he was making the system more rational. He was making it more binding. The capitatio jugatio did not free Roman farmers from fiscal pressure. It attached them to it permanently. Just as modern tax structures do not free ordinary wage earners from their obligations, they attach those obligations to the most visible and least avoidable form of income, the paycheck, while allowing less visible and more avoidable forms of wealth to flow through structures that ordinary people cannot access and most ordinary people do not even know exist. The Roman poor paid their taxes, not because the system was fair, because they had no alternative, no exemptions, no offshore structures, no political representation in the bodies that designed their obligations. No patrons powerful enough to absorb their burden, just the collector at the door and the obligation that did not adjust for their circumstances. 2,000 years later, the architecture is more sophisticated, the mechanisms are more obscured, the language is more neutral. But the fundamental structure, extraction concentrated on those least able to resist it, protection extended to those most able to design it, has not changed in any way that matters to the person trying to understand why their effective tax rate is higher than that of a billionaire. The vault has been open since the first Roman senator voted on the first tributum rate. The question is whether anyone ever intended for you to see what the design process looked like from the inside.